Hello everyone, this is Abhijit Chatterjee recording our weekly session for Chartsarefun. This is for the last week of February, for the week of February 24th. Recording this on March 2nd, the Sunday. Well, it was an extremely rocky week last week. We know that the market dropped quite a lot, and we know that there was significant concerns from consumers and investors in general. The previous week, the Michigan consumer sentiment came out at 64.7, significantly lower than last entire year, and almost matching closer towards the end of 2023. This just week that just ended, we saw very, very sharp movements lower. In particular, the Magnificent Seven stocks got hammered. NVDA was, expected to be the barometer of the AI spending. Turned out NVIDIA did beat their numbers. The expectation for 38 billion, they crossed over 39 million. They beat by a billion. But the margin, their gross margins was lower than what market expected. They have been guiding low 70s for the immediate term, and then later in the year expecting that margin to climb back up towards the mid 70s that they typically report. So today's agenda is simple. We're going to look at the market. We can see, is this really a next bear market starting like what we got in 2022? We will look at what the core indicators in the market telling us. In particular, we look at the New York Stock Exchange Summation Index. I've talked about it. I've said, written blogs about it. To me, that's a key cycle indicator of the market. I think, and we'll explain why we think the market is some more upside. That said, taking a longer term view of S&P 500, in particular the monthly chart, looking at the last 10 years of the S&P 500, we do see concerns about potentially a 10 to 15% correction shaping up this summer. So we will talk about it. We do want to prepare for it, but in the near term, we do see some upside. And then we will talk about Bitcoin. It was an extremely volatile week. It broke down from what people, the technicians, call as a double top. And we'll see how Bitcoin turned back higher towards late Friday. And then look at Magnificent Seven, two of the key momentum stocks, NVIDIA and Tesla. And then the ETF for Magnificent Seven, which is around Hill's Magnificent Seven ETF called MAGS. So this is our blog site, chartsarefun.substack.com. We appreciate you subscribing to it. Our YouTube site is also Chartsarefun. The channel is youtube.com/chartsarefun. Appreciate you hitting the like button, and also if you could subscribe to the channel. So let's start off with where we think the market fear gauge is. We know that if you just type in on YouTube stock market crash, we can see that there are warnings across the board about very bearish things. People concerned about Trump's second term. Tesla's sales falling in Europe because of sentiment being very poor about Elon Musk, his activities in the Doge, and so on. You can see urgent warnings, buckle up, recession coming, stock market crash coming, stock market crash. You'll see very bearish stuff's game over across the board. Only one person stands out, Tom Lee. Not one, he's one of the rare ones, who seems to continue to be bullish, saying money's on the sidelines. We talked about him last week as well. He was in Risk Reversal show in one of the podcasts I follow with Guy Adami and Dan Nathan, and he did talk about his bullishness from a contrarian perspective. He thinks that in particular, the American Association of Individual Investors Sentiment Survey significantly panicked. The bears in that rose up to 60%, which kind of goes back to terms that we have not seen in a while in the last couple of years till the previous bear market. So we look at that. He also feels money in the sideline will come back in to coast the market higher. And he feels that fundamentally, while yes, there are concerns about tariffs, there are concerns about growth scare, and perhaps a slowdown in the economy. Some of the people are still talking about the R word, the recession. But Tom Lee continues to be bullish. He continues to take a contrarian view, and he's the only one who kind of stands out and talks about buying the dip. I'm going to show the American Association of Individual Investor website, the sentiment survey that was released last week. It's a weekly survey. It's conducted from the midnight of Friday of a Wednesday. So from a Thursday to the next Wednesday, it's every week they conduct the survey and then they announce the results on every Thursday. So if you look at the week ending 226, which was what we got on Wednesday, so it was till the end of day on Wednesday, 60.6%. Red in bears, green in bulls. 19% bulls, 20% about neutral, but 60% of the people who were polled were bearish. The previous week, 40%. The 2 weeks before that, 47%. So all of February, it has been hovering in the 40s, but shot up to 60% last week. Can't blame them. Market has been very volatile, and we will shortly talk about what the market has done. Historical, if you look at the historical average, bears tend to be about evenly. In fact, you can see more leaning on the bullish side. 37.5% is the bulls, 31% bears. So it's kind of split evenly in the three. In the neutral camp, about 31.5%, but slight edge to the bulls at 37.5% are bullish on average. The highest reading we got was on July of 2024 at 52.7% bulls. Not surprising. Remember, mid-July was when many of the core stocks peaked, and then we got that Japanese stock market crash early August. Very similar kind of volatility move and very similar kind of market pullback is happening this last couple of weeks, like what we got back in late July into August. And I explained that, looking at in particular the New York Summation Index, the New York Stock Exchange Summation Index. The highest bearish sign we see was back in last week, February 26, 2025, 60.6%. This is for the 1 year kind of, reading. Now, if you look at the chart of that, you can plan it out, and this is a monthly chart. That high level of 60 that we saw, 60.6, was last seen in the part of the 2022 bottom of the bear market, right going into from September into August. Around that time, August into September, we saw similar bearishness as we are seeing now. A very sharp climb, just like, all of 24, we were climbing from down at 19%, right? These are the percent of bears, by the way, AAII bears. So it was only 19% bears in the late 23, climbs gradually through the year of 24, and here right into February of 25. This is a monthly chart. Every bar is a month. February of is start up from 33 to 60. That's a very sharp climb. That shows capitulation. It shows extreme fear. Often when there's extreme fear, market tends to form a bottom, at least near-term bottom. So that's bullish. That's a bullish sign that the AAA, the American Association of Individual Investor, bearishness is at 60%, like from the peak of when the bear market bottomed in 2022. The other key pattern, and I've been talking about this, written a blog about it, also in this weekend blog we talked about it, is this summation index, which is a market breadth indicator. It cycles between 1100 to minus 1100. You don't get those minus 1100s during a bull market recovery. You get those minus 1100s in the 2022 and part of 2023 when we were the bear markets part of the pullback. 1100 was what we saw recently as September, early September. Since then, it's been declining, and it declined for 3 months from that late September, early October till early January. We declined, and then that upcycle has just started. In this pattern, what we see is the MACD, which is the moving average convergence divergence, shown here with the black line going above the red line and then going below the red line, going above the red line. It cycles back and forth. This MACD is effectively showing us the 12 and the 26 period moving average of this summation index. The key pattern to look at is this blue histogram. Look at the beautiful bell-shaped curve, right? It kind of cycles up, then cycles down, crosses below the zero line, cycles down, climbs back up again, crosses above the zero line, goes and forms a beautiful bell shape, crosses below the zero line. The durations can vary depending on the cycles. Sometimes it can be, as we can see, over a month of, this is a daily chart. So in this case, this duration can cycle over a month from May through early June. Sometimes this one was also over a month. Sometimes it can be a bit longer. It can be over almost a month and a half. From early October, it cycled on the lower side till it was able to climb up towards late November, almost 2 months on the lower side. That said, this recent upcycle of the MACD histogram happened from maybe the first week of January till very recent, till the previous week, not the week that we just ended, but the 2 weeks before that. That's still when it started declining below. Every time you have a MACD crossover going below the zero line, look at these blue elliptical regions. Look at the lowermost panel, which is VIX. VIX shooting up means market pulls back. Volatility shooting up usually is an indicator of market pulls back. So every time this has happened in the last, year of data that we're looking at, we see that every time the MACD has crossed the black line gone below the red line, or the histogram has gone below the center zero line, we have gotten a VIX climb. Doesn't always have to be a spike. This was a spike because of the Japanese stock market crash. VIX climbed quite a lot. Again, in early September, VIX climbed. Early October, VIX climbed. Late December, after December 18th, when Powell went hawkish on the market, saying that he's going to put a pause on interest rate cuts, volatility shot up. And look at what happened recently. The signal indicator I'm pointing out here is watch for this MACD on the Summation Index cross over the center line. Every time that happens, be prepared for a volatility move, be prepared for a market pullback. And that's what I had indicated even before this all happened 2 weeks ago. Check out my videos that talked about I'm expecting a market move lower with the Summation Index preparing to cross below the zero line. That said, what I'm expecting is in the weekly chart of this typically climbs for several weeks before it cycles lower again, climbs for several weeks before it cycles lower again. So in the very recent movement we saw, the last early January, we 1, 2, 3, 4, 5, 6 weeks of climb. We got 1 week of decline. Look at what happened in the July timeframe through the early October. Climbed for 6 weeks, 1 week of decline, then back again, 3 weeks of climb, 2 weeks of decline, back again, 2 weeks of climb. Stair-step climb. In that stair-step climb, look at what RSI did. RSI had got oversold, went back above the 70 line. Look at what MACD did. MACD typically, when it becomes extremely oversold, the black line pulls back to the negative region. It usually climbs back up to the positive region, pulls back to the negative region, climbs back up to the positive region. Where is the MACD signal line now? It's still negative, minus 110 on the black and minus 146 on the red line. They are both got weeks to climb before they go to the positive territory. So my prediction is we will get volatility pull back. We will get these to continue to climb, and we expect this to look at the pattern of the higher lows. MACD, because we're in a bull run right now, recovering from the 2022 bear market. So at least in the near term, the next month or two, I expect MACD of this New York Stock Exchange Summation Index to climb. That means market breadth improves. That means broader participation of stocks moving higher. And that means there's a good chance this goes back and tests that 1100 level again from a higher low pattern. 1138, as I said, in the bear market extremes, you get Summation Index pulled to the minus 1100, which was in the bottom of the bear market, the previous bear market of October 2022. From there, shot up to 1100, a higher low at minus 834, back towards 1100, a higher low at minus 435. I expect this to climb back to the 1100. That's the signal I'm watching before we know that we are hitting some term of an intermediate term top in the market and then start becoming more cautious about a deeper market pullback. Till then, this is what I'm expecting. Look at this beautiful ascending channel. Yes, this was a bit of a scare from the breakdown below the bottom of the channel. This has been a channel since the August low. Join the peaks, join the bottoms. This is a parallel channel along which the S&P has been climbing. Yes, this has been a bit of a scary event. We kind of broke below the trend line, but less where we reversed higher. This was on Thursday. This is a daily chart. Every candle is a daily movement. S&P did break below it, closed out a gap. We can see this gap right here from the CPI. The day the CPI data was released, the following day, it market gapped higher. So that gap from the CPI was somewhere around 58.42. That's where it had closed on the day before the CPI. 58.42 it closed, the low was 58.38. So this was a gap close and then a reversal higher the following day, which is on Friday, reclaiming that trend line. I expect this to start climbing. Why? Let's look at a little longer term chart from a daily to a weekly. Every bar here is a week. What are we seeing? We are seeing a classic Elliott wave pattern of a 5-wave move from this low at 34.91, which we hit in the bear market and at October of 2022. So this is a classic 5-wave move of the first impulsive wave. So in parentheses are the impulsive waves of a larger Elliott wave move. So that's wave 1. That wave 1 had 5 subwaves. That the subwaves are marked with Roman numerals, and the impulsive waves are marked with the digits. The 1, 2, wave 1, wave 2 is the pullback wave, corrective wave. The next impulsive wave to wave 3 is right here to 56.69. Then the pullback to 6119 is the corrective wave. We have not ended the impulsive wave, which is the end of the 5th wave. That to me is where this upside reversal is coming. Beautifully test of that trend line. While you saw on the daily chart of S&P 500 a break below that trend line, not on the weekly chart. The weekly chart joins the lows all the way from here, from October of 2023, higher lows. Notice the line joining the higher lows. It did not cross below it. The low was 58.38, and you can see that the trend line was around 58.10. It did not cross below it, and it's rebounding. It had a nice tail here. This is a bullish reversal tail. So this tail tells us we are likely going to reverse higher. The dotted line arrow is telling us we go back to the top of the trend line. And that measured target is somewhere around 6,500, 6,600. We can expect to see this pretty quickly happen over the next couple of months. Once we reach there, then I feel that the wave 5 of this 5-wave move is going to end. This is where I've labeled 5. So as I said, the Roman numerals are the subwaves. So the first wave 1 had 5 sub-wave move. Wave 1, wave 2, wave 3, wave 4, wave 5. So those 5 subwaves of that primary wave, wave 1. Then like you got an ABC correction of wave 2. Then another 5 subwave move of 1, 2, 3, 4, 5. That formed the third wave 3 or the second impulsive wave. Then another pullback, which is a corrective wave, which is wave 4 from 56.69 to 51.19. And now we are on that 5th wave. We've got the Roman numeral 1 subwave, Roman numeral 2 second subwave, the third subwave, the fourth. Now the 5th subwave is what's going to resume. I expect this climb towards that 65, 6,600, giving us the 5-wave move of this bullish. And also, if I look at a longer term monthly chart, look at the trend lines here joining the highs and the bottoms. That 666, 666 was the low of 2009. Join it to the bottom of 2191. Beautiful trend line climbing. Are we anywhere close to that trend line? No. Where are we? We are still hovering around the top of that trend line. Have we touched the top of that trend line? Not really. This high here from 2008, joining the high at 48.18, which we saw in early 2022 before we got the bear market pullback, recovered back. We have so far touched 61.47 in February, and now we are about to climb and touch the top of that trend line, which is around 65, 6,600. So I expect that to happen. And then potentially something that is concerning to me is what I would like to highlight here is the monthly chart of S&P 500. What is this telling us? This is telling us, again, love the MACD pattern. This is MACD on a monthly chart, a longer term horizon. Every bar here is a month. Look at what MACD did in late 21 into 22. MACD histogram curved lower, and then it went below the zero line. As that, and typically this histogram going below the zero line coincides with the signal line of the MACD going below the smoothing line, the 9-period moving average in red. So the black below went below the red. That's when the histogram went below the center line. And as that happened, look at what the market did, a pullback. Look at how far the price had diverged from the 50. Here, the blue is the 50-month moving average. Red is the 200-month moving average. But from the 50-month moving average, pretty much it's been climbing touching it, right? You see it touched it here in 2016, it touched it in late 2018. It in COVID fell below it, but quickly recovered, climbed, tested that 50-month. It rarely goes below the 50-month in a secular bull market. It tested it, started climbing again. But look at that dotted blue line showing how far price had diverged from the moving average. That's here 48.18. The moving average was somewhere around 3,500. Talking about 1,300 points is how far it had diverged. Where are we now? The moving average is about 45.93. Let's round it to 4,600. We tested 6,100. 4,600, 6,100, we're talking about 1,500 points, even further away from the 1,300 point divergence. This is indicating, this is a classic law of reversion of mean reversion. When you diverge that much away, the market has got a bit too overbought. You can expect a move lower. Not expecting a 50-month test, which is we can see near 4,600. That would be quite a sharp pullback, way more than 20%, because I'm expecting a move up to 6,500 and then a 20% move from down there, which is about 1,300 points from 6,500 closer to the 5,200. That's what I'm expecting. In this year, potentially we could see the 20% move. The concerns are, main indicator is this MACD histogram. Look at how the MACD histogram has started to curve. I love these bell shape. I love these beautiful curves that they plot out. Look at this beautiful curve. That, once the decline starts, indicates momentum. These are momentum indicators. MACD and RSI is now beginning to go negative. Bears are taking control. So what we just saw last week was an teaser to a concerning time coming ahead. Not bullish for the year, bullish for the near term. Near term, I'm expecting S&P to climb towards the 65, 6,600, because as I said, this is that wave sub-wave climb to complete the larger wave 5 of the bull run that started from 34.91. 65, 6,600, that is going to be what we will see in the next couple of months. Late April, early May, I would start getting concerned about this bearish sign of the S&P 500. That to me is where we could start seeing. So look at late 2021. Look at how we had a bearish candle. This is November of 21. Everyone got bearish, but guess what happened in December? That December, we had a bullish reversal till the point where it peaked out. Last shakeout of the, bears were short, and then bears take control after that. And this is the month of January of 2022, where we saw a candle where we got a sharp pullback. And then very quickly, over a span of 8 to 9, 10 months, we pull back to test that 50-month moving average in the same year in 2022. This is where we are setting up. I expect, look at how we ended the month. We ended it in kind of a doji. We opened at around 59.69, we ended at 59.54. That's a beautiful doji. That's often also a reversal candle. When you open an indecision, open and close the month at the same level and had a tail and kind of a, on the top and the bottom of that, that could be a reversal. But that said, I feel that we will get a similar kind of move as December of 2021. We will get a climb. This was a false signal till we get overexuberance, and that overexuberance will then indicate a market top. And then by that time, we will start seeing the MACD to start declining. Now I'm going to talk about Bitcoin, because Bitcoin had a major shakeout, and look at the beautiful reversal. This is a daily chart of Bitcoin. Look at the beautiful reversal that happened from Saturday into Sunday. This is from near 85,000. It is now trading 24/7. It trades constantly. It's now almost close to 94,000. Huge ups move in Bitcoin. What did it do? It broke down from what bears would call, or technicians would call, as a double top pattern. 91K was huge support, tested the top near 108, 109 twice, once in December, once in January. Measured target of that is 91 to 109 is 18,000. Subtract 18 from 91, you're getting to 73,000, 72.9. That's the measured target on the double top. Did we hit that? Not really. It came close, but it came to 78.2, and I'll show you why it had a beautiful reversal of 78.2. That was a key trend line that it tested and it reversed. But Look at the reversal. It's the beauty. On Friday, it left a very long reversal tail, closed above the 200-day moving average. The 200-day moving average is 82,000. It closed above it. And then Saturday, Sunday, two bullish candles and massive recovery in Bitcoin price. So from 78,000 was the low of Friday. Look at where it is now, 94,000. So you're talking about a $16,000, 20% climb right there in the span of 2 days. This is what typically speculative investments do. This has also got a beautiful 5-wave move. I talked about 5 waves. This is the 15,000 low that Bitcoin saw in 2022 October. Wave 1 was from 15,000 to 73.8. Wave 2 pullback from 73.8 towards the 49.2. Wave 3, so that's the primary wave, corrective wave, the next primary wave. They're typically an Elliott wave. 3 primary waves, 2 corrective waves. So the first primary wave, 15.4 to 73.8. Then we got the bearish pullback, 73.8 to 49.2. That's the corrective wave. Then the next primary wave from 49.2 to 109.2. That's right there, 60,000. So the first one was 15 to 73, 58,000, 60,000, about the same length on wave 1 and wave 2. Pullback from there to that trend line that we joined the lows. Look at where the trend line was. It was right around that 78,000 is where it rebounded. So it beautifully tested the trend line. You can see the tops and the bottoms. And I expect this climb now to the wave 5, that'll climb to the top of test of the channel, which is going to climb. If you measure just a 60,000 to 78, that right there is 138,000. Even if you do 58,000 like we got wave 1, sometimes wave 1 and wave 3s, wave 1 and wave 5s are identical. So if this is 58, 78 plus 58 takes you towards 136. So anywhere from 130 to 136, 138 is where I think we will top out in Bitcoin in the near term. As I said, I am expecting a bearish pullback, S&P 500, after this steep climb we see in the next couple of months. I do see a bearish pullback, 10 to 15% correction. I would expect Bitcoin at that point from the 138 get cut into half, pull back towards that key support level near 73. That's what I expect it to happen. NVDA was in the news. They had announced earnings. I talked about Jensen Huang being very bullish. Market was expecting 38 billion revenue. They announced 39.3, so exceeded it. Projections for next quarter is 40, so 39 to 42, 3 billion continued growth. But what the market did not like was the gross margin. It typically has been in the mid 70s, 75, 76. It is now going towards 71 is what they're projecting for the next quarter. Market didn't like it. It tanked. And what did it do? It tanked and jumped beautifully off a pennant shape, the low end of the trend lines, joining the lows all the way from April of 2024 near 75, higher lows, 75, 90, 149. And guess where it rebounded off this week? Near 116, which was right that low, right? So classic pennant, if you join the tops and join the bottoms. NVIDIA right now might be range bound in between this pennant till something bullish happens and it breaks higher. We don't know what the news is. We know that there is all the hyperscalers announced tremendous amount of AI spending. They've been actively announced GPU buying, but these hyperscalers, these are big customers. When they buy, they tend to negotiate great prices. That's what hit NVIDIA's margin. Their Blackwell is rolled out, but that's the next generation of chips. These big customers are negotiating because they're buying in bulk in large volume GPUs, lower prices. Negotiating lower prices as a result gives NVIDIA a margin hit. That's why the price took a dip. But guess what Jensen said? Jensen said the pattern of AI usage is typically in the past being spot usage, as in you make a quick call to an LLM, you get a response right back. That's been the spot usage, an instantaneous response. However, the reasoning usage of AI is what's coming and it's going to be used more and more in the next several months. The reasoning usage uses a lot more GPU capacity. It needs a lot more compute. Jensen talked about 100 times more compute needed in the next couple of years. Guess what that'll do? Not all compute is GPU. Inferencing typically is CPU-bound inferencing, but GPUs will be needed when some part of the complex computations happen. So talking about compute, he was as bullish as 100 times all the way to million times compute over the next decade is where he sees compute shoot up as AI becomes more and more reasoning. Guess why? The reasoning of AI as it becomes more human-like is how do we as humans think through everything? We reason, we try to come back with responses, not always just like a computer does. We show step by step, we show how we work through reasoning into kind of coming up with a response. Expect that kind of usage. The reasoning part of response be more compute intensive. That's going to drive more growth for NVIDIA's revenues and its sales. So that's the growth. If this pennant breaks out, there's a beautiful measured target from 140 to 90, back towards the 140. This is in many ways ascending triangle. You get 140 and you see the higher lows. 90 to 140 is $50. At 50 to 140, 190. Bulls would still target a 190, and I would not be surprised if NVIDIA gets there. It's a possibility NVIDIA could hit 190 before this market tops out in the 6,500. I don't expect the S&P to hit 6,500 with the MAGS just all struggling. Expect some form of upside in the MAGS as in the Magnificent Seven. Not every one of these will do very well. Let's look at Tesla. 488 from a 273. What a jump, more than double. All the euphoria about Elon Musk benefiting from his Trump association, huge shoot up, and also his big statements about the cyber cab or the cyber car announcement, more of the, fully supervised driving, not have any humans behind the wheels. That kind of what drove the stock higher. And then as Doge came into being after the inauguration, more and more of bearish news started coming up with Musk spending more time in Doge than in the company itself. Pullback came very sharply from 4088, got cut, towards back to where it rose from. Guess where it rebounded on Friday? 273.54 was the previous peak, right? From where it pulled to 238, and then it shot up after election. That gap in the election night that from November 3rd to 4th, that gap is where it now becomes strong support. So that gap opened at 275 and climbed all the way. So that 275, it came and it tested exactly that previous high of 273.54 at 273.6. Call it a computer trading, call it coincidence, but fascinating coincidence. So I think Tesla is setting up for a rebound. Beautiful test of that was previously 271, 273 as huge resistance, is now massive support. I consider this as a successful test, rebound from 270 to 292. I wouldn't be surprised in the near term, this declining channel, a test at the top of the channel is near 325. I expect Tesla, and you can see the 325 level from where it tested, went to 367 and broke down. I see an immediate test of 325 coming in the next several days. That's where I would see Tesla at least go up, hit some resistance, maybe do a little bit of a pullback, and then likely break even higher. So 275 or 273 towards the 325, talking about 50 to 52 points. Add that, takes it back above towards 377, that level right there. So first the 325, next the 377. Those are the two key levels in Tesla I'd be watching for a rebound potential move in the next couple of weeks to a couple of months. When I end with the Magnificent 7 ETF round hill, this is a beautiful ascending triangle as well, from 49 to 38, back to 49, higher lows, 38, 41, 47. That ascending triangle measured to a target near $61. Did it touch 61? Not quite. It hit 58, pulled back. It was kind of trading in a range-bound pattern most of December through January to mid-February, and then it broke down. You know that except Meta, every other Magnificent 7 stocks reacted poorly after earnings. That Magnificent 7 ETF as a result broke down. But guess what is the pattern? This is called a bullish wedge pattern. Breaking down along that wedge, that reversal, testing what level? A very key level near 49.5. It tested 49.38. That beautiful resistance is now support, identical to Tesla. That beautiful resistance is now support and testing it successfully and rebounding. Same thing with Magnificent 7. Beautiful resistance is now support, ready for a rebound. I wouldn't be surprised to see Magnificent 7 ETF MAGS go back and test and achieve that target. If S&P has got to climb back up towards the 6,500 level, I'm expecting in the next couple of months for that melt up kind of a wave 5 high, I would not be surprised to see MAGS These are the trillion-dollar stocks. These move indexes. I wouldn't be surprised to see a recovery in the Magnificent Seven ETF, taking it back towards the 61 level that it's ascending triangle. To sum it up, as I said, I feel that the summation index pointed to us near term of a volatility. We saw the volatility when the summation index MACD dipped below the center line. Then we on the weekly chart, we are seeing more upside towards the 1100 level of the summation index, which is when the advancers outnumber the decliners and you get strong breadth climb towards the 1100 level is where expect the NSI summation index NYSI to climb to. Along that line, we expect S&P has reclaimed its channel and now expected to go to the top of the channel. That top of the channel measures, as we see from that sub 4, that sub wave, the fifth sub wave from near that 58.38 towards that 65.66. That's where I see it climb. I see that also in the longer term chart or the monthly chart. The top trend line measures towards the 6,500 level. And I would not be surprised after that to start seeing a bear market kind of shape up later into 2025. So second half, I am getting concerned. I do feel maybe these tariffs will come into place and shake up the market. Maybe we get some form of a recessionary pullback. We know that Atlanta GDP now has already talked about a negative, quarter one number. Quarter one numbers don't come out till late April. So once we see those numbers, market could get a bit of a concern. And you know that there has been government induced with the deficit spending climb to the market. That's now curbing back. You know that the government is spending less on stimulating that kind of government spending. That's going to have an impact to GDP. It's going to have an impact to potentially recession. And we know that there's been a lot of layoffs in the government sector. So this MACD curving lower is indication of a potential bearish pullback coming. I would be concerned. In the next couple of months, I would start raising cash and be very, very cautious moving ahead. That said, next couple of months, looking very bullish, play the upside, and try to lighten up as you can during that period. Thank you so much for watching the video. Talk to you next week.